ನಿನ್ನೆ ಬರ್ತಿದೆ. Good morning, class. Welcome to this session of Strategic Financial Management. Before we continue further, in our last class, we completed net income approach. The last 3 sums we had discussed, and after that we started discussing weighted average cost of capital. What is weighted average cost of capital? Now it simply tells the costs of different sources of finance, yes, or different sources of capital. Here there are two things, one is weight and other one is cost. Now what is weight represents? Yes, weight represents market value of different sources of capital. What does cost represents? Yes, the rate of return expected by each investor. Yes. Now, weighted average cost of capital. What happens to optimum capital structure? When we consider a problem under weighted average cost of capital, at a particular time we consider a particular portion of capital structure to be optimum. It's just that what explanation I gave, the question I have asked it in reverse. So whenever the weighted average cost of capital is minimum, we consider such portion of debt and equity mix to be optimum capital structure. Yes. What happens weight? We start assigning weight to each of the capital based on its market value and rate of return that is being expected by investors. Yes. See, weight is market value, cost is expected rate of return. Then here the expected rate of return always depends upon the risk what the investor pursues. Now it is said that the cost of capital is always interdependent on degree of leverage. What does that mean? Or in simple words, it depends upon the degree of leverage. Now what does that mean? What is degree of leverage or what is level of leverage? Leverage tells what portion of debt is present in the capital structure. Now it is being said that your weighted average cost of capital is always dependent on degree of leverage. That means whenever the debt portion increases, the weighted average cost of capital tends to decrease, because debt is a cheaper source of fund compared to that of equity. Yes, that's why your weighted average cost of capital can be said that it is dependent on degree of leverage. Okay. Now moving forward, yes, regarding this I already said how to consider optimum capital structure under weighted average cost of capital. Now this particular topic has not been specifically mentioned, but then to understand optimal capital structure, you will have to know weighted average cost of capital. Okay. Now it is not that, do not bang your heads behind this. In the explanation I have given, but now maybe like the word degree of leverage, whenever that word you read, all those things what we discussed just now, what do we mean by leverage, what portion would be increased, all those things you should remember. Now how you will remember depends upon how much concentration you will have when you listen. Because when you do concentrate, definitely there would arise some kind of questions. Now that there are no questions being raised for the first time in the history of SFM classes, I doubt whether it is you actually understand or is it that you are not paying any kind of attention. Strategic financial management is very simple, but it is highly confusing. You will have to put effort anymore. For 10 months you enjoyed. Anymore, just put a little bit of effort. Okay? Yes. So the second approach is net operating income approach. Now net operating income approach is also being proposed by Durant. Okay, the same person who gave a net income approach. But then the basic thing about net operating income is that it is drastically opposite of net income approach. Now when I tell drastically opposite, to tell how it is opposite, you should know what is net income approach. So what does net income approach tell in one sentence? What does net income approach tells? The first approach. Yes, net income approach tells that capital structure is relevant for the decisions to be taken by an organization. Yes, that means whenever the debt equity portion is being changed, it will have some kind of effect on the value of the firm and thereby on the market value of the shares, or it should have been on the market value of the shares. That's when you will have changes in the value of the firm. That is what net income approach tells. So if NOI approach is exactly opposite of NI approach, what does net operating income approach proposes? Okay, fine. Now that is exactly the opposite, that capital structure decisions are irrelevant for an organization. What does that mean? Or for that matter, why does this approach proposes that the capital structure decisions are irrelevant? Why? Now the sentence we can by heart, but why does it? You'll have to understand. Yes? Why? See, once you know it in very simple terms, you can explain it how much ever you want. Okay? Whenever you hear NI approach, you should remember one sentence, that is capital structure decisions are relevant. Yes? If you know NI approach and this one sentence, then you can come up with NOI approach. Then you can come up even traditional approach and MM hypothesis. Yes, the basics you should know. The rest of the sense forget, that you will be able to make. You are that capable, aren't you all? Yes, but one theory, one idea you should know. So, if NI approach tells that it is irrelevant, NOI will tell it is irrelevant. NI is relevant, NOI is irrelevant. That sometimes you will not hear when I tell. Okay? It is irrelevant. But why is it irrelevant according to approach? Or how is it irrelevant? Yes. Or in other words, this approach tells that the weighted average cost of capital. If now that word irritates you so much, you can just think of cost of capital. Yes, this particular approach tells that cost of capital irrespective of level of gearing. Whenever they tell level of gearing, once again it simply means that the portion of debt, okay, in the capital structure. It tells that under NOI approach, irrespective of what portion of debt or equity you have, the cost of capital is going to remain same. But why does that happen? Is it true? Yes. Now this has already been explained in last class. The thing is, most of you were not present for online class either. Yes. And I have not uploaded. So when things comes, when you have to sit and study, I know how to make you all sit and study. When I have to let you all free, I know how to give all the things which makes your life still more easier. But some things what you have to study, I will definitely make you all sit and study it. Your IBE, I will not bother. Your SFM, I will not allow you freely. Theory, I left it freely. I might have said 1000 times that theory is important. You would have concentrated on theory. Today, this situation might not have existed. Isn't it? Okay. Now, the underlying assumption under this idea or behind telling that irrespective of the level of gearing, cost of capital will not be changing is that when it is done, when this thing happens practically, okay, what happens is the more debt portion increases, what do we assume? That cost of capital decreases. Practically what happens is when debt starts increasing, the equity shareholders tend to perceive that the risk that they would face will also increase. Okay? Now, why do they think like that? They think like that because whenever debt portion increases, the organization will be having some kind of obligation, a fixed obligation on a fixed base and a fixed price. Yes, to pay back to the creditors. Yes. So now when you will have to pay more, definitely the profit start decreasing. So to whom does all this profit belongs? Equity shareholders? Yes. So when they think that their profit is coming less, their rate of return which they expect will start increasing because of the more risk that is being present now. Yes. Now out of whatever, even if it is 100 rupees, the company is obliged to pay, yes, some portion. Now there is more and more portion will go for creditors. And on the other hand, when it comes to equity shareholders, there is no such obligation that dividend should be paid compulsory. If profit is there, only then the organization pays. Not only that, only when in your general body meeting they decide they are going to pay dividend, only then they would pay. Yes, all those things practically you know, right? That is why in simple words, if we have to tell, whenever the debt portion in the capital structure increases, the risk perceived by equity shareholders will also increase. And when on the other hand, you do also know that whenever the debt portion increases, the cost of capital decreases. But then because of the increased perceived risk of equity shareholders, whatever the advantage now you would have got because of using debt would be equally cancelled because of the increased risk by equity shareholders. That's why NOI approach tells that irrespective of level of gearing, your cost of capital is going to remain changed. There would be changes, but changes would happen in such a way that there would be no any change at the last. The cost of capital, the cost of debt definitely decreases, but cost of equity will increase. Now the decrease and increase would be equal. Okay, that is why under NOI approach it is said capital structure theory are irrelevant. The capital structure decisions are irrelevant. Yes. Now can you differentiate between NI approach and NOI approach? Yes. Net income approach and net operating income approach. Both have been given by Durant. Yes. Net income approach he tells capital structure decisions are irrelevant. Yes. Relevant or it does matter. If relevant and irrelevant is confusing, keep those two words away. NI approach tells yes, the decisions when it changes, there is going to be some kind of changes in the value of the firm. So NI approach tells that if that is the case, then you will have to take all those decisions which will make the cost of capital least, the market value of the shares high, and thereby the value of the firm also should increase. That is all about NI approach. Net operating income approach is exactly opposite of that. Okay, and even NOI approach has also been proposed by the same person. He tells that the capital structure decisions are irrelevant, and he gives reasons why it is irrelevant. He tells that yes, when debt is increased, cost of capital or cost of debt definitely decreases. But then because of the increasing debt, the risk perceived by equity shareholders will increase. Now it will increase to an exact proportion of the decrease in cost of capital. And these two things makes the capital structure decisions irrelevant for the valuation of the firm. Okay. Now do you know the difference? See. Now this approach has also been suggested by Durant. This approach is diametrically opposite of NI approach. Now the essence of this approach is that capital structure decision of a firm is irrelevant. Why? According to this approach, the value of the firm is independent of its capital structure. Now it assumes that weighted average cost of capital will remain unchanged irrespective of level of gearing. Now, there you know what is weighted average cost of capital. Now, there you should also know what is level of gearing. Level of gearing tells what is the portion of debt in the capital structure. Yes. Now, the assumption that is behind this approach is that the increase in the employment of debt in capital employment of debt, it increases the expected rate of return by stockholders, and the benefit of using relatively cheaper debt funds is offset by the loss arising out of increase in the cost of equity. Okay, now these 4 sentences, if I tell, it might take 30 seconds, but then I might used more than 15 minutes to explain that. So, if at all a theory question comes, you will have to explain each and every word the way we discussed right now. Okay? So, when you see only so much, you should be able to tell all those things. What is weighted average cost of capital, or for what say does there would be an offset between the two. Okay? Yes? So, is the concept clear? See, if you have any doubt, you will have to tell it right now. See, there is no going forward before you understand it. You understood? Faster. It is so easy. Once you study here, you need not go and check, provided you actually understood it. I will definitely not scold you all if you tell me you did not understand. But what goes through your brain, I definitely cannot tell. So, you will have to tell me whether did you actually understand it or not. Understood, those whoever are present here? Fine. Shall we continue? Yes, up until this point we had said, I guess. Okay. See, now these are in how might be they would tell in financial management textbook. These are the words from the textbook. You can always explain it the way we have discussed, right? But certain words you do need to remember. Than words, you need to remember the idea behind each of the approach. Fine. And once again, in today's afternoon class, do concentrate and listen. Okay. Since it is a guest lecture, might be they will not take so much of time. So, you will have to understand the concept quick. Now, even that is a very important chapter. I will definitely not repeat it once again. She will be doing chapter 2, the first concept, that is valuation of bonds. Okay? Yes. Yes. Now, the next one is assumption. Now, why does assumptions are important? Faster. Now, assumptions are nothing but I had said earlier, assumptions are the statements which makes the approaches true. If these assumptions are not considered, then all these approaches stands to be false or exactly opposite of what it happens in the actual market or how it happens practically. Yes? Is it yes or no? Yes. Now, once again, understanding the concept is important because anymore you people are the ones who will analyze the situations. Okay? Now, it is not simply a work of clerk you do, that you have such amount, you tell what has been given where and you tell how much money is remaining. That is not the work. Your work would be you analyze the situation and you will have to suggest things, or you will have to find reasons why things are like that. So, for you understanding the concept becomes very, very important. Now, when you go out and start working, might be the situation is different, or for that matter of fact, definitely it would be different. But remember, your work is not counting. Okay? You will have to understand the concept, whichever it might be, starting with your managerial accounting. Now, that if you do not concentrate, you are going to face a lot of problems, be it in your own subject, be it in your project. Okay? Start thinking of different project ideas. Now, when I tell ideas, I tell for everyone together. It is not the title you come up with. Okay? I don't know how much smart you are. Go to Google, just type, give me different titles of financial management project, you will get. When I ask, especially for my students I am doing, and when I ask, you will have to come up with the ideas what you will do. Title we can fix it later on. Okay? Ideas you will have to come up with, telling what you would do if you take that particular topic. Titles do not give. Title I have given to my lecturer, my students before this have given to me. I have enough number of titles. What I need is ideas. Okay? Now coming back to theory, I just gave 5 minutes so that I approach the process in your brain. Coming back to the assumption, the first assumption tells that the overall cost of capital remains constant for all degree of debt equity mix or leverage. Okay? What does that mean? Explain before 5 minutes. Cost of capital, or what did we tell? Weighted average cost of capital. Now, it will remain unchanged or constant for all level of gearing, means is going to be constant for all degrees of debt, equity, mix or leverage. It is the same sentence, both the sentence means the same, just that the words are different here. Okay? Now, whatever meaning we said, now all those meaning itself is the assumption of NOI approach. Here one of the calculation that you will have to remember is how you would calculate the value of the B is equal to EBIT divided by K naught. Remember your NI approach. Remember your NI approach. There we had to calculate cost of capital. So there what did you use? K naught is equal to EBIT divided by V. So this is simple math. You have the value of K naught, you have the value of EBIT, whereas you do not have the value of V. So you tend to calculate V is equal to EBIT divided by K naught. This one formula you remember, but the way how we calculate V or the value of the firm under NOI approach, you have still one more formula. Okay? As we progress, you shall know it. Then second assumption is that let us keep everything aside. Okay? A matter of the fact, when it is market, the market is going to value the entire organization as one. For the market, it doesn't matter you debt more or equity more. For market, what matters is how much your company values. Whether it is safe to invest in your organization. If I invest in your organization, will I get more return? That is the only the market asks. Market, which market? the manufactured goods what you sell in the black market? Yes. For you people, whenever it is market, it would be the share markets. Okay? International, national, it doesn't matter. Whenever under financial management we tell market, it is the capital market we are speaking. So the market values the entire firm as 1. So for the market, it doesn't matter whether you have debt more or equity more. All that matters is the share price of your the market price of your shares should be high. Fine. So even in practical sense, the debt end portion is not going to matter. Is what particular assumption tells. And the third assumption is the same as the reason why capital structure decisions are irrelevant. It tells that the decrease in the cost debt is equally offset by the increase in the expected return of equity shareholders. That is what the third assumption tells. Yes. Now there are different words. It could be equity capitalization rate, the rate of return expected, or cost of equity. All means the one and the same. And the last assumption is that there are no corporate tax. I guess up until this point we had discussed in last class. Yes. Now there are something called as presumptions. What might be this? Now you have 4 assumptions under this. Okay. You might go through any of the books that has been suggested in your syllabus. Hopefully you have downloaded it, or you have at least saved what has been sent in the group. Now you can suggest any of the books, or I do such financial management given by I.M. Pandey and M.Y. Khan. Now I.M. Pandey's textbook has been circulated in your Telegram group, if I am not wrong. The entire textbook is there in the soft copy. Okay. So do not give me the reason at the end that you did not have a textbook. What textbook we use, same has been given. Now that particular textbook is useful for your MA also. All that has been discussed is there in the same book. Okay. So don't give the reason you did not have library. Fine. Now I set the link also, send the link where you can find the textbook. Any time of any day you can find the textbook in that particular link I have given. So no more reasons telling you could not study because you did not have textbook. Yes. Now presumptions are nothing but there are certain things you will have to know before understanding or solving the problems. The first presumption is regarding the residual value of equity. What might be this? Remember telling that in the first chapter we used to tell owners of residue. Remember that word? What does owner of residue means? To whom we tend to tell as owners of residue, or what is residue? Go back and see all those video clipping if at all it is so pleasant to hear. Okay. Maybe for 10 minutes, 15 minutes straight I have said what is owners of residue, who are those. It is just every year, I am studying. Maybe now is the time when I sit and I also write exam, so that some marks, at least my marks card would increase. Yes, who are the owners of residue? Whom do you call as owners of residue? Yes? Preferential shareholders. Are they owners of residue? Residue simply means something remaining. Yes? Something is remained. Residue is remained. Now, if at all you might have a mixture of anything. You might have seen in the kitchen itself something you have mixed. But if water is mixed and it is such a substance which does not mix, after some times the water would be separated, the remaining would be standing down. Now, that part you tend to call it as residue, isn't it? That remaining at the bottom. So, now what is residue when it comes for organization or a firm? The remaining profit we tend to call it as residue. So, to whom does the remaining profit belongs to? Equity shareholders. So, anymore you will not forget who are the owners of residue. Whatever remaining, the owners are none but the equity shareholders. So, if at all tomorrow in second internals, if I ask who explain at least 10 sentences regarding owners of residue, you will know all things what you know under equity shareholders. Okay? Yes. Now, residue value of equity simply tells that the value of equity is what remains at the last, which belongs to the equity shareholders. And according to this problem, we can calculate the value of equity by deducting the value of the debt from the value of the firm. So, whatever remaining is nothing but the residual value of equity. Okay, you might understand it better. Okay. Now, before we can take down the explanation for this, the value of equity is the residual value which is determined by deducting the total value of debt from the total value of debt from the total value of the firm. Okay, and it can be symbolically represented as S is equal to V minus B, where what does S stands for? Yes. So, you can know the total value of equity when you deduct the total value of debt, which is being represented by V. When you deduct it from total value of firm, which is being represented by V, you can get the total value of equity. So, under NI approach, how did you use to calculate the value of shares or S? S is equal to, yes, you had the value of net income available for equity shareholders. Yes, that you used to divide it from equity capitalization rate, and you used to get the value of shares. Here under NOI approach, to know the value of equity shares or to know the market value of equity shares, you have to deduct the total value of debt from the total value of the firm. Yes? So, how will you find out the total value of the firm? You have EBIT, you will have K0. Yes? So, you know two formulas which you will have to use in the problem. Okay. Now, the next presumption is regarding changes in equity capitalization rate. Sorry, changes in the cost of equity. Now, what is equity capitalization rate? It is one and the same. Equity capitalization rate or cost of equity or the return expected from equity, all the three are same. Yes. Now, what does this tell? The same thing we discussed under assumption, the same thing we discussed under your meaning of NOI approach. So, what does this tell? There is a lot of things, you will have to be faster. See, it is not that I cannot finish. I can finish giving one sentence and I can finish off the subject. But what remains here is what matters. Okay? For that matter, your PPTs are ready, your handouts are ready. You can do self-reading. But something should remain here, no? Even the exams, when you go out. Now, if at all in an interview they ask, what does the hypothesis tells? It should flash in a second. Don't worry, even I would be asked with the same question every single year. I am not scaring you all, I am just telling what the reality is. Okay? For which all of us have to be ready. There is no other option. Coming back to your changes in cost of equity, what does that tell? It tells that cost of equity capital increases with degree of leverage. What does that mean? Cost of equity increases when the debt portion in the firm or capital structure increases. Why? You do know why it happens. Because the more and more debt is being there in capital structure, it will have some kind of effect on the risk which is perceived by shareholders. So, when the risk tends to increase, it will have its effect on the equity shareholders increasing their expected rate of return. That would directly increase the cost of equity. Okay. So, second sentence you can take down is the equity capitalization rate or cost of equity capital. If you want, you can mention it symbolically, that is KE. The equity capitalization rate or cost of equity capital increases with the degree of leverage. Okay. Now, the explanation to that you will have to give. So, in bracket write explain or just write it inside the that give reason why does that happen. So that whenever you have to speak regarding presumptions, it is not only you write the sentence, you explain after that. Okay, it is. Now, when I give handouts, you might be thinking of, taking a photocopy of that. But then I will tell you it is better to maintain a notebook, okay? Because I do want your notebook once after finishing your classes. I do check it. So you will have to anyhow write. So how much will it take to write 15 more minutes every day whenever the classes are there? Do not take the handouts. I mean the photocopies of the handouts. Start writing so that you will also learn once again. The next, before this, the formula would be this. How you would calculate cost of equity. Okay. There are two different formulas. That is, first one is cost of equity can be calculated by the formula K naught plus K naught minus Ki multiplied by B divided by S. Now Ke represents cost of equity or equity capitalization rate. K naught represents overall cost of capital. Now whenever we tell overall cost of capital, yes, it does include both the cost of debt and cost of equity. But here you do not know how, KE you would not be knowing in specific terms. Okay. Now once again K naught represents overall cost of equity, Ki represents cost of debt, B represents total amount of debt, S represents total amount of equity. Or you do have one more formula which tells if you have the value of earning before interest and tax, the total amount of interest and the value of shares, you can find the value of equity. That is EBIT minus I divided by S. Did you all take down? A bit confusing, yes, but easier provided you understand and you will have to spend time studying. Even me, when I was in your situation, even I did not understand at once. Okay, maybe you will be able to by heart it, go tomorrow and write exam. Maybe you will pass. But you will have to understand these things. For that, you will have to sit and study. Okay. Now, when you know the basics, when you know what it is, even though if they give a complicated question, to some extent you will be able to solve it. Because under your strategic financial management, it is not like your managerial accounting or your accounts that you have a certain procedure to follow. It is the ideas and how it come to a conclusion, right? That is all about SFM. Now your earlier problems that we saw, there was not particular structure. Structure we had put a table and we had done, right? It is all regarding the information, what is the basic idea behind the concept and how you would solve. Now the third presumption is regarding cost of debt. What is cost of debt? Yes, it is Ki or KD. Yes. Now follow one single thing. When it is, just remember, when you tell K, it is cost. D can be debt. Okay. That represents cost of debt. I is nothing but interest, and interest you tend to pay on debt. So it can be KI or KD. E is nothing but your equity. K naught is nothing but both together. So do not get confused. S is nothing but shares. They have not given E, but they have given S. It is nothing but your shares. V is value of the firm. V stands for value. B is nothing but your debt. Maybe when this idea was proposed, it seriously for 1 hour. Yes, let me check. Okay. For 1 hour I was on mute. For whom did I tell? Okay. I just understood I was like mute for an hour. I do not know for whom did I shout a lot. So whatever it is, now half an hour. Thank you for the information. Yes? Yes? I did not hear you, Pratiksha. I guess it was Pratiksha. I hope you heard. From which point you all did not hear? Can anybody answer that question? Yes. From which point did you all not? Changes in cost of equity. Where was that? Presumption, second point. Oh, okay. Then there was some issue with the network, not with me. Okay, now whatever it is, take a break of 5 minutes. We shall continue so that your brain, my brain, both works together. Be back at 11:03 or 11:04. I would be very much devastated if it was for 1 hour that I was mute. Bake online class. I guess I irritated my teachers a lot and they trust me to be one. there, go back to your strategic financial management group, WhatsApp group, ask them to join once again. The meeting got end somehow. Who will text? Somebody, anybody? That's why you should not become class rep. Understood? And you are so lucky that yours is like never ending process. Like you are mad to listen for 5 hours. Welcome back to this session of strategic financial management. I hope I am audible. If I am not, please let me know. Just check no one. If I am not audible, how will they know that I have asked the question? Yes. Now the second presumption is that changes in cost of equity. Now this particular presumption tells that whenever there is changes in degree of leverage, there would be changes in cost of equity. Now how does that happens and why does it happens? We have already discussed in the meaning of NOI approach. Now it assumes that yes, when debt is increased, the cost of debt or the expenses that is related to debt will to some extent decrease. Okay, but then the more and more debt is increased, it is going to have an effect on equity shareholders. They think that because of more debt, the risk that is attached to their shares would also increase. That's when they ask more return. So according to this presumption, it tells that the advantage that the organization earns because of using debt is offset by the disadvantage of the risk perceived by equity shareholders. Fine. The last one is cost of debt. Now, what might be this cost of debt? We understood cost of equity. What is cost of debt? Now, once again, it is the same what we discussed. Okay. Before that, under cost of debt, you have two things. Okay. One is what we call as explicit cost. The other one is implicit cost. Now, what might be these two? Explicit cost and implicit cost. First one under cost of debt is explicit cost. The second one is implicit cost. Okay. Now, first one, let us see explicit cost. What is this explicit cost? Now, speaking regarding explicit cost, we tend to tell cost as explicit cost, which has been mentioned in clear words. Okay, for you all to understand, explicit cost is that. Now, what is the cost which has been mentioned here regarding debt? What has been exactly said? You have debt, right? Debt could be anything, a loan taken, a bonds given, a debentures given away. Yes. Now, under those things, what is the cost would be specifically mentioned? Which cost? You are able to understand what sentences I am telling? See, now under cost of debt, you know what is cost of debt. What is cost of debt? The expenses related to debt makes up the cost of debt. Now they are telling there are two different kinds. One is explicit cost and the other is implicit cost. Now when we speak regarding explicit cost, it represents the expenses which are specifically mentioned. Now, whenever you have a debt, which is that one expense which they would specifically mention? Rate of interest. Do they mention specifically whenever a loan is given or bond is given or a debentures is given? Will they mention 10% or how much you have to give? So, that can we consider it to be explicit cost? So, what does explicit cost means? It represented or explicit cost is represented by rate of interest. Okay. Now, regarding this particular thing, you know what is implicit cost. Okay. And why are we speaking regarding implicit cost here? Now, NOI approach, along with all its assumptions, presumption, it tells that the cost of debt has been specifically mentioned. Okay, it simply means there is going to be no any changes in. Okay, and according to this, it presumes that the lenders or the ones who give the credit to the organization, they will not penalize the organization for the fact that there has been increase in the debt. Is that true? Can that happen in reality? Can that happen in reality? See, now what this particular approach tells, according to the assumption, the rate of interest is going to remain constant. Okay, but is that the situation? Is what the person is right now. Okay, what happens in reality? Whenever the debt increases more and more, not only the equity holders, but the lenders or the creditors of organization also start thinking that the organization is not having the strength to raise the capital through the way of equity. It simply means it is in a difficult position in the market. When that happens, the creditors usually start losing their faith on the organization. When they do not have faith in the organization, that is to tell, if they give money, the faith of the lenders is that at said rate of interest, at that time, you will get the money back. Now, losing faith simply means that they are not having the faith that you will pay them back. When that happens, usually the rate raising. But what the approach tells, irrespective of portion of debt equity mix, the cost of capital remains unchanged, which is totally opposite of what it might have practical. Okay. Now, do you need explanation for this? Take down. Explicit cost. Now, it is represented by rate of interest. Now, irrespective of degree of leverage, the firm is assumed to be borrowed at a given rate of interest. This implies that the increasing proportion of debt in the financial structure does not affect the financial risk of the lenders, and they do not penalize the firm. They do not penalize. penalize. Penalize simply means punish. Penalize the firm by charging higher interest. Okay. Now, the rest of the things you should be able to explain. Fine. So, the second one is implicit cost. What does that mean? What does that mean? Implicit cost. If explicit cost is what has been specifically mentioned, what might be implicit cost? Yes, not specifically mentioned or hidden cost. So, whenever you speak of cost of debt, what's been hidden here? We said it all the way along when we said the meaning, when we said the assumption, when we said the changes in cost of equity also. Okay. Here the implicit cost or the hidden cost represent that portion of the expense which is increased due to increase in the debt portion. Okay. That portion of equity which has raised because of using more and more debt, that is being represented by implicit cost, or that is the hidden cost. Directly there is no increase, but indirectly, there is no increase, but it has increased through the way of equity shares. That represents the implicit cost or the hidden cost. Okay. Will you take down? As shown in the assumption, relating to the changes in cost of equity happens changes with changes in debt proportion. Full stop. This increase in cost of equity being attributable to increase in debt is the implicit cost of debt. Okay. Now we studied regarding optimum capital structure, what it means. We said what is optimum capital structure under net income approach. We studied what is optimum capital structure when weighted average cost of capital happens. Yes. Now can you tell me what are the three different things? Optimum capital structure simply means that portion of debt and equity mix for any organization where the cost of capital is less, the market value of shares or market value of the firm is highest. When it is NI approach, it should always take such a decision wherein the cost of capital would be lowest, the market value of shares would be highest, therefore the value of the firm will also increase. Under weighted average cost of capital, any capital portion, debt and equity portion, which has the lowest cost of capital or lowest weighted average cost of capital is considered to be optimum capital structure. So what might be the optimum capital structure under net operating income approach? Yes. You know what is NOI approach? So which or what portion can we consider as optimum capital structure? Yes, faster. For this one I need answer from your side. What is NOI approach tells? It tells capital structure decision is irrelevant. NOI approach, net operating income approach, the one we are studying, it tells irrelevant. So what is optimum capital structure? There is no such thing as optimum capital structure because there would be no any changes according to NOI approach. Irrespective of debt portion, irrespective of equity portion, the cost of capital is going to remain same. So that's when it tells the cost of capital or the capital structure decision is irrelevant. If that is the case, out of all the options available, can we consider anything as optimum capital structure? Definitely no, because each one we cannot choose, right? Because irrespective of what you choose, the cost of capital is going to be same. So what is the, where is the thing that we can select? For us what matters? Cost of capital is low. Yes. So when all the things are same, why do we have to choose? Whatever is our decision, can we go with that? According to NOI approach, it is, because when cost of capital and the value of the firm remains unchanged, it doesn't matter which portion you take. All that you take becomes the optimum capital structure. So in your handouts it is there. Is it enough or should I tell it once again? So I will just read through it, okay, because it is there in your handouts. I will just read through it. Now the total value of the firm is unaffected by its capital structure, no matter what the degree of leverage is. The total value of the firm will remain constant. The market price of shares will also not change with the change in debt equity ratio. There is nothing such as an optimum capital structure. Any capital structure is optimum according to NOI approach. So now you know 4 different things. Yes? So can we tell NOI approach is exactly opposite of NI approach? Okay. Now having said this, what might happen for optimum capital structure if we take into consider tax, corporate tax? We said debt and equity doesn't affect here. That's why there is no such thing as optimum capital structure. What if we consider corporate tax? What might happen? See, keeping into consideration all the things, the approach stands the same. Whatever we discussed until now, it is the same. But we shall add one thing, that is, there is corporate tax. So if we add corporate tax, how might your optimum capital structure be? Remember one thing, if at all we consider corporate tax under net operating income approach, the optimum capital structure stands at a position when the organization is totally made of debt, or when there is 100% of debt, because interest paid on debt will have effect on the tax being paid. The more interest you pay for the debt, the less taxes you would be paying. So under net operating income approach, if we consider corporate tax, the optimum capital structure of the company would a position when it is 100% made out of debt. But since we are taking corporate tax, we should also know that due to some of the provisions under some of the rules and regulations under Companies Act, no company can be made out of 100% tax. There has to be certain portions of equity also. Okay? So when that is the case, the optimum capital structure would stand at that place. The equity is lowest possible and the rest is made out of debt. Fine. Now that's where your theories or approaches are different from how it can be in practice. Fine. Now you have an idea of optimum capital structure of an OI approach or operating income approach. That we shall tell more net income. this we tell operating income, so that you are not confused. So now whether you have a clear, at least some idea of what is NI, NOI? Yes? So shall we move towards the problem? Yes. Go through the first question. It tells that a company named XY Limited has an earning before tax of 1 lakh rupees. The cost of debt stands at 10% and the outstanding debt amount is 4 lakhs. Presuming the overall capitalization rate is 12.5%, calculate total value of the firm and equity capitalization rate. So did you all understand the question? What does question tells? First, it is telling the name of the company. It tells that the earning before tax is 1 lakh, that the cost of debt stands at 10% and the amount of debt is 4 lakh, and equity capitalization, and the overall capitalization rate is 12.5%, and you are expected to value the firm and the equity capitalization rate. So what are the things that has been given? First is EBIT, which stands at 1 lakh. Next is your, how do you represent it? KI or KD. It stands at 10%. Then what have they given? B, the total value of debt. It stands at 4 lakh. And what they have given? KO or overall cost of capital. Here they have mentioned overall capitalization rate. Okay, and it stands at 12.5% or 0.125. Okay, and what did they ask? What do they need in the form of answer? Yes, first one, the value of the firm, V. Yes, the next one is KE, cost of equity or equity capitalization rate. Whether for all these things when we studied the theory, the formulas had been given? Yes, for V, for KE and for, yes, only for 2. So, V and KE had the formula been given? Okay. Now, from which step will you start? Okay. Table showing valuation of firm under NOI approach, operating income approach. Here the difference is the way how we calculate the value of the firm. Yes, the formula is different than that of NI approach. So did you start? See. You can write anything, statement showing, table showing. Okay. Okay. Now EBIT have they given? Yes, and it stands at 1 lakh. Should I do it on the board? See, yes, the EBIT is 1 lakh. and the K naught is nothing but overall capitalization rate. It is 12.5%. Now these two are the information that has been provided in the question. Yes, that's why here you can put 2 underlines. That is the information that they have given. Now the first thing that they ask is what? Value of the firm. How will you calculate the value of the firm? What is KO? Yes. Do it. See, you have the formula which has been given in your assumption. V is equal to EBIT divided by K naught. Now this is what I said. Now you can use different methods. If you directly divide it by 12.5, you will have to multiply with it by 100. If you are taking 0.125, there is no such necessary. So at what rate does the value of the firm stands? Is it correct? Wait. Now this is the answer of some other question. See, this particular answer is of some other question. Okay. Yes. What is the total value of debt? What is the total value of debt? 4 lakh. See, look here properly. This is not correct. It only stands at 4 lakh. Now, if I give everything the same way, it would be difficult for you all to. So, this would be 4 lakh. So, when you deduct 4 from 8, what would be remaining? It's what is the total value of debt? What is the total value of debt? Yes, it has been given in your question. So it is, see, this answer is wrong. You will have to draw a proper answer. So 8 minus 4 stands at 4 lakh. So what is equity capitalization rate? What is the formula? KE is equal to EBIT minus I V minus B. You have different formulas, right? EBIT minus I divided by S was given, correct? But whether do you have the value of S here in the question? Do you have the value of S? It has been given. That directly you can put. Otherwise, V minus B is the same thing what you did here. 8 minus 4 is 4 lakhs. This can be this or yes. Okay. So, what is EBIT? 1 lakh minus interest. What is interest? What is interest? You have 1 lakh of debt, and what is the rate of debt? Sorry, yeah. What is the debt you have? 1 lakh minus 40,000. 10% of 4 lakh is what? 40,000. How did you get this 40,000? You have 4 lakhs of debt and the rate of debt is 10%. That is how you got 40,000. And whether it is S or V minus B, it is one and the same. Did we have a formula which said S is equal to V minus B? Yes, Raksha and Kirtana, what is the doubt there? Yes. What is the answer? 60,000 divided by 4 lakh. Yes. 0.15 is how much? 5%. Yeah. 0.15. Correct? Or when you have to mention it in terms of percentage, you will have to multiply it by 100. That is necessary for you to find out the value of K0. Okay? See, actually, your problem stops here at this particular point when you find out equity capitalization rate. Now, this particular thing or the K0, it simply verifies the problem. I have already given overall cost of equity to be 12.5%. Using that formula, if you substitute everything and if you get 0.125 or 12.5, your answer is correct. Now, this particular question, for this particular question, it is not the answer. Okay. Now, the verification is here KD stands at 10%. Total value of B is 4 lakh. Value of the firm is nothing but 8 lakh. Okay. And KE is 15%. The value of S is 4 lakh and the value of firm is 8 lakh. So, 10 into 4 by 8 plus 15 by 4 ones are 4, 4 twos are 8. So, this would come 10 into half. that will stand at 5%. Yes, once again 4 ones are 4 twos are 15 into half would be 5% plus 7.5%. So, is it standing at 12.5%? You should keep your calculators aside and start calculating. See, 10 into 4 by 8 it is. Yes, 4 ones are 4, 4 twos are 8. 10 into half is 5. Correct? 15 the same. 4 ones are 4 twos are. 15 into half is 7.5. 7.5 plus 5 is 12.5. It is very simple math. You do not want to use your calculators. Okay. Now, what are the things that you will have to give under this particular question? Is there any working note necessary? Why? Because according to the formula we have done. We haven't assumed anything here. Yes? When we calculated V, we calculated it on the basis of earning before interest and tax and your cost of capital. Both have been specifically mentioned. And KE also we assumed on a formula wherein all the information was given. So, there are no any working note for this particular problem. So, what is the conclusion? According to NOI approach, the value of the firm according to net operating income approach, the value of the firm is rupees 8 lakh, and that equity capitalization rate stands at 15%. Yes, that's it, and you can finish the problem. Okay. Now, we said irrespective of whatever portion the debt and equity may be, yes, the value of the firm will not change. And on the other hand, what does happen? See, the value of the firm is not going to change, but when debt is increased, what happens? What is the other thing? The value of equity increases. Yes? Sorry, the cost of equity increases. Is it so? That is what the net operating income approach tells. When you increase the debt portion, the value is going to remain unchanged, but it also simply means that rate of equity does increase, right? Because that has to happen, otherwise your value there would be change. When the rate of debt decreases, the rate of equity should increase. Only then can the value of the firm remain at a constant amount. Yes? Otherwise it is going to affect, right? Now it is always other way around when it is strategic financial management. They said it is not going to change, but for that not to change, when one decreases, the other has to increase. That is the simple idea behind that. So we will take one more question. See, this was correct. This is of the first problem. Okay. Now this, there is a mistake, I would change before giving it to you. Fine. Now the second question, do go through it. XY Limited has an EBIT of 1 lakh rupees. The cost of debt is 10% and the outstanding debt amount is 4 lakh. Presuming the overall capitalization rate is 12.5%, the company decides to raise the sum of rupees 1 lakh through debt at 10% and uses the proceeds to pay off the equity shareholders. Calculate the total value of the firm and equity capitalization rate. So what has been given? First, EBIT. It stands at 1 lakh. They have given a rate of debt which stands at 10%. They have given the total value of debt. It is 4 lakh. And the equity capitalization rate is 12.5% or 0.125. Okay. But then what the company is telling? It has decided to increase the debt by 1 lakh. And it is increasing the capital by issuing 10% debt. And they are asking you to value the total, calculate the total value of the firm and also equity capitalization rate. How will you calculate the value of the firm? V is equal to yes, you can do S minus B, but S is not there right now. Okay. What information you have is cost of capital and earning before interest and tax. So V is equal to 4 lakh divided by 0.125. How much will be the value of the company? What is the value of the company? 8 lakh. What is the next thing that you will have to know? KE. Yes. See, now you see here one thing. Yes, concentrate here. You have the formula V is equal to EBIT minus I divided by V minus B. Now, if we take that formula, is this step necessary? Now, if we take this particular formula, V is equal to EBIT minus I, V minus B, whether this step is necessary? Why? You have the value of the firm which you calculated 8 lakh. You have the value of the debt. Why do you think it is necessary, that particular step? So if you consider this step, you can directly write here S, right? Yes or no? Yes. So the equity capitalization rate is EBIT minus I divided by V minus B, or it can also be EBIT minus I divided by S, where EBIT stands for earning before interest and tax. I stands for, yes, remember one thing, it is not being symbolically represented by small letter I. Yes, Raksha? Okay. So here when it is capital I, it is total amount of interest that you will have to put, not the 10%. Do not do such small mistakes. See the formula, EBIT minus I. Here you will have to put total amount. Never forget that. Okay. So minus it is 50,000 they have given. Why is it 50,000? 5 lakh. But in the question it was 4 lakh, 4 lakh, 4 lakh, right? So why there has been increase to 5 lakh? Yes. In the information they have given that there has been increase in the debt. So 5 lakh into 10% would be 50,000. So when you do all those things, at what rate does the equity capitalization stands? Yes, what is the equity capitalization rate? What is KE? See, start working out, otherwise on the day of the exam you will be too much confused. Your problem stops here. Fine. At this point your problem stops. Whatever this is, it is for verification. This is all but verification. See, here you have written K naught is 12.5%. So you will have to get 12.50% here. So that when this matches this, the problem is correct. For that you will have to know this particular formula of K naught. Now this is being given from the theory part also. From the start this particular formula was there. You will have to write conclusion. Yes? What conclusion will you write? See, now to write conclusion, you will have to make 2 columns and do. Okay. First one where you do not consider 5 lakh, you consider only 4 lakh. See this problem here. The equity capitalization rate was 15%, correct? But when you increase debt from 4 to 5 lakh, what is the equity capitalization rate? 16.67%. Has there been any increase in equity capitalization rate? Yes? No? What it is? See, that is the conclusion you will have to give, right? When the debt was increased, the equity capitalization rate also increased. Yes, did it happen? Whether the cost of debt was remaining same, both problems it is 10%. Even after the debt was increasing, it stand at 10%. Now that happened because of the assumption, correct? That it is going to remain unchanged. But in reality, the case is opposite of what it is. So can you give conclusion? So for today's class, shall we wind it up here? Yes. Thank you class for your patience listening. We shall wind it up here.